So hi and welcome back. In today's video, we're going to be covering the annual percentage rate or APR. So let's get started. First things first, what exactly is APR? Well, it stands for annual percentage rate. Essentially what APR does is that it shows you the cost of borrowing money. So it includes not only the interest, but additional fees that are attached to having that particular loan type. Why is understanding APR important? Well, let's imagine that you're trying to compare two different loan products. One has lower fees but a higher interest rate, and the other loan has a lower interest rate but higher fees. Well, just looking at those numbers, you can't really tell which one's a better deal for you, and that's where APR falls in. APR is the standardized means or a number that encompasses both interest rate and additional charges. So therefore, if you are looking at the balance between the two products, you should be able to, via APR, understand which one is going to cost you a little bit more. APR is expressed as a number that is tied to a percentage. So you're going to hear like an APR of 28.99%. And it's applicable to all types of loan products. So credit cards, mortgages, loans, etc. Credit cards are actually special in that they have multiple APRs. And for that reason, I made a separate video. So click on that if you want to know more about credit card APRs. So now let's do a quick breakdown of a very simple APR formula. So the formula for calculating APR is as follows. Your APR is equal to total cost of borrowing divided by the principal amount. Then you divide that by the total number of days in the loan term, multiply that by 365, and then multiply that by 100. The total cost of borrowing. So this is not only the interest charges, but also any fees or costs associated with the loan, thinking origination fees, processing fees, or annual fees. Principal amount. That's either the initial amount borrowed or the outstanding balance on the loan. Number of days in the year. So that 365 up there could actually be also 360. Some banks use 360 because it is cleanly 12 times 30, and depending on lender conventions. So you want to make sure you're paying attention to that in order to understand how they came up with their APR. Lastly, number of days in the loan term. So that's the total number of days in the loan term. This is especially important for loans with terms that are not a full year or loans that are over a year long. So let's break down this formula really quickly with an example of a personal loan. So you're considering a personal loan for a total of $10,000. It is a 1-year loan, so your loan term is going to be 365 days. There is an origination fee of $300, and the interest rate for that personal loan is 6%. So because this loan is a 1-year loan, your interest could be just very simple. So we're going to do the principal amount times the interest rate. So that's $10,000 times 0.06. So your total interest is going to be $600. Then we're going to calculate the total cost of borrowing. So that's the total interest plus your origination fee. So in this case, it's $600 plus $300. So you have a total of $900. Then we divide that by the total amount of the loan. So 900 divided by 10,000 equals 0.09. Then we're going to divide that by the total number of days in the loan term. It's a 1-year loan, so it's 0.09 divided by 365, which is equal to 0.00246575. Then we're going to multiply that by 365 to find the annual rate, so we're back to 0.09. And then we multiply that by 100 to convert the rate into a percentage, making it 9%. So it's important to note that this formula is a very basic formula and it is calculated using generally simple interest, so it doesn't actually do anything with compounding interest, and for most loans, compounding interest does occur either on a monthly basis or a daily basis in the cases of credit cards. In general, I highly recommend that you use an APR calculator online, and there are so many out there, and it allows you to input more variables into it so that way you can get a better idea of the annual percentage rate versus using a formula which is highly simple. How does APR affect you in the real world? So essentially, understanding that APR is the total cost of borrowing money. The higher the APR, the higher the cost. The lower the APR, the lower the cost. So if you have a good or great credit score, generally you qualify for lower APRs, and therefore you get a slight discount compared to somebody else with lower credit. For the most part, your APR is going to be higher than the advertised interest rate for the loan, and that's simply because it also accounts for fees. Speaking of fees, because mortgages have a lot of fees that could be tied to your mortgage payment, as well as the fact that it is generally the longest type of loan a person will have, I made a separate video of it that you can find here. Now you got an idea that APR just kind of tells you how much it's going to cost you to borrow money based off of those loan terms. For the most part, you don't have to calculate it, but you will see it highly advertised across all of your lending paperwork because it's a requirement that the lender, mortgager, etc. lists it for you and discloses it. So it's just a tool that you can have to make a comparison towards a different but similar type of loan, and it's just something to keep in mind. If you found this video helpful, please leave a comment down below. Say hi. I'm more than happy to respond. In fact, I love responding. Do me a favor, give this video a like, share it with a friend, and I'll see you in the next one. Bye!